Hello everyone. Welcome to the market update featuring by Rational and Market Soul. Welcome to another week, another like a busy week, another tiring week. This week we got a lot to unpack though. Markets are like reacting to conflicting economic data. The Fed's like a rate cut expectation resulting as like all these incoming data flow, growing concerns about tariffs under like Trump's administration. We'll start by breaking down the latest US unemployment report as we received last week, where some underlying data is some maybe raising questions about the labor market. Then we'll take a closer look at the ISM and the global PMI data, and we'll also discuss Germany's massive fiscal expansion plan and what it could mean for the bond market and euro currency. Plus Japan is officially declaring an end to like a deflation period. What does this mean for the yen and global markets? Finally, we'll wrap up with the latest tariff developments and how markets are reacting. If you're trading FX or commodities, equities, you wouldn't want to miss this one. Let's get into it. First of all, here you see the economic calendar since our last market update video. First of all, we had started the week with this news: U.S. tariffs was in effect, and that had, up until that time, the a risk on sentiment was at least on a better shape. But then after this data, again, markets started to be choppy, and on Wednesday we received ADP non-farm employment data, which is kind of an indicative data for the non-farm payroll employment data. I'll show you this time data by data in order to see if there is a concrete sign of any kind of recession risk, at least, because without seeing data, without seeing a concrete thing, market's fear is too much right now. That's why I would just wanted to start with the last week data. So ADP employment data for February came in 77K, significantly below 140K, marking the weakest since July 2024. Wage growth also at that time remained unchanged for 4.7 for job stayers, and for the job changers it's 6.7, the lowest since October. It's since its lowest since October. It's nice that it's kind of indication that inflation risk on the wage side is not that concerning right now, and we had also seen this kind of implication on non-farm payroll data that I will come just in a few minutes. Then we had received ISM services and S&P Global PMI numbers. As you can see here, while S&P number, S&P number and ISM numbers are contradicting a bit. First of all, S&P number covers a broader range of job titles, including executives like CEOs and CFOs. It indicated a slowdown in the service sector, while manufacturing has yet to contract because of the tariffs. Probably manufacturing businesses did kind of a stocking before those tariffs coming. That's why there were still some activity going on. That's why manufacturing numbers was much better. But ISM data, which is based on responses from purchasing and supply executives, the ISM service index did not confirm the slowdown that we have seen in the S&P service data. So that was actually a good news, because with this mentality, with our current fear of is the recession coming, is due to all this uncertainty going on, we need to answer the question: do we see such implication on data? Is there any concrete evidence on it? And this ISM S&P numbers, when you check that, yeah, I mean, nothing to worry for now. Still, the base scenario is soft landing. There is nothing to see that at least disrupt this scenario. So when we come to the non-farm payroll data, it was the highlight data. It was like it's the main data that we need to dig into, understand if the economic activity is doing well, if the labor market doing well. The data did not like indicate a major deviation from the soft landing narrative as well. However, like broader unemployment data, like which is like it includes also like a part-time jobs and stuff, jumped sharply to 8% from 7.5% in January, reaching its highest level since October 2021. That was a bit concerning. The headline number came in 151K, slightly below expectations, but still close to consensus. I think the headline number was not that effective. And like when you check the initial reaction of the market, I generally look to the bond markets when a new data is coming. So the initial reaction of the market was against the headline number, which came a little bit lower than the forecast. Then they bought. Then after that, the focus shifted to average hourly earnings data that I'll come right now. The government, when you look at the details, you might all remember that when we were seeking more, like when we were focused more on inflation, let's say the fourth quarter of 2024, when the non-farm data, non-farm payroll number comes, we were looking at the from which sides of employment is which side of the employment is strong, and we had seen a lot of support was coming from government side. And with the doji, Department of Government Efficiency, you can see in the current data, government jobs declined 10K in February, and this trend is expected to continue into the March. As I mentioned, like the decline is related to doji related factors. Excluding government jobs, private sector employment saw its a 3-month average drop from 204K to 169K. 169K is not a bad number, but at least you see some a decline from the 204K. It's still, I think this side also consistent with soft landing scenario. But what I believe that is due to the support from the government side in 2024 to the labor market, I think in the non-farm payroll data, I think we have some room out there. If we see more declines on the government side, it might be compensated. That's why I think the major focus should be shifted to private sector. And there is a metric if you get into the into the BLS website, you can see that it's table B, I guess. You can see there's a 3-month average of total private sector, and if you check that, following that one would give more hint about the current situation of the private sector. The unemployment rate was reported around a 4.1%. However, the household survey showed a 588K employment loss. So the positive side of definitely positive side of this number, this data, was definitely we didn't see any inflationary signs on wage, because that was the main concern. If the wage price spiral is intact, that means the inflation will keep being sticky, and that's the biggest risk on that side, and we didn't see any kind of indication on that side. That's why I think this didn't change the main narrative of the soft landing scenario. But definitely uncertainties coming from tariff side definitely is controlling the markets reaction right now rather than this like a data flow. So I think current situation, that huge sell-off in equity markets and like a risky asset, is more speculative than being realistic. That's why I think the current main uptrend is still intact, and these kind of corrections are pretty normal. And like to be honest, I would rather to zoom out in these kind of cases to see some weekly charts and stuff, to see some consolidation, to see some low risk entry opportunities, and like to be patient in these times is pretty important. Apart from that, last week we Germany's we received like some news from that they're gonna do expansionary fiscal reforms, which is like not that usual for like a conservative mindset, like a more conservative mindset on fiscal expansion. Like Germany, it's like a 500 billion infrastructure fund. It's equivalent to 11.6% of GDP over 10 years. Defense spending exempt from debt limits. That's another important side, because defense spending exceeding 1% of GDP will not be constrained, allowing for a potential short-term defense budget to increase like a 3% of GDP. And what's the implication of it? More debt means more bonds. They need to issue more bonds, and a rise in bond supply typically leads to lower bond prices, right? And higher yields. Like it's due to the nature of like a yields and bond prices relation. So this could attract the foreign capital for sure. However, if market see excessive debt issuance as a risk, which concerns about like a fiscal sustainability could emerge, leading to like some capital outflows and euro weakness. So if fiscal expansion fuels inflation, the ECB might tighten monetary policy, which could support the euro for sure. But if bond yields rise due to debt concerns rather than growth, rather than productivity, the euro could face downward pressure. The current situation is the first one, like it is expected to have some inflationary impact, and that's why we see huge like a jump in euro. But that will be I think the evaluation to assess this situation. We need to assess markets reaction, markets perception on if they're gonna see this huge debt issue, or if they're gonna see this as a productivity or growth issue. That's how I evaluate this latest development on that side. On the other hand, last week ECB, the European Central Bank, cut interest rates for the 6th time since June. However, future policy moves are still uncertain, especially with Europe, they're increasing defense spending following like a US pullback from Ukraine. That will be decisive. And one other thing from the Japan side, they declared the end of deflation. So Japan's government is expected to they were expected to say that official end of this long-standing deflation. As you might know that they were a liquidity trap, where they were trying to boost the growth with lowering interest rate, but it wasn't working. That's why, as a result, there was a ongoing deflation. And they are looking for 4 key indicators, which are output gap, CPI for sure, GDP deflator, and unit labor cost. They all have turned positive. The output gap flipped in Q4 2024, which could influence Bank of Japan's next rate hike. They're on the path of hiking rates. That's why I had mentioned in my previous videos that I'm bullish on Japanese yen. And when we come to this week, recession worries take center stage. Wall Street main fear Trump's policies could disrupt this soft landing narrative, and which this sparked the sell-off on Monday in the beginning of this week. And a technology site drove Nasdaq's biggest single day drop since 2022. And like Trump actually did not rule out a recession and stated his economic changes would lead to a period of transition. Their claim is like, okay, this is like an initial reaction of the market, and these are so normal, but at some point this going to change. That's their claim. And on Tuesday we received like a JOLTS data, which like a slightly exceeded expectation, but had a little market impact. Apart from that, tariff developments lately. Last week, according to FactSet data, analysts have lowered S&P 500 EPS estimates more than usual for the other Q1 estimates, citing the inflation and like a tariff risks. So the like a bottom up like a EPS estimate dropped from 62.89 to like a 60 levels. That's concerning for the growth side, because like that's concerning for the end of year forecast on S&P 500. Apart from that, on tariff side, Donald Trump announced plan to raise tariffs on all like a steel and aluminum imports from Canada to 50%. The S&P 500 had like its worst session like on like Monday. After that, with that like aluminum and steel news, it got worse. And like currently like market pricing is shaping around like a VIX volatility index remain elevated around like a 28 levels. Treasury yields remained like a 4.20 levels after like we saw some dip on Monday with the uncertainty that people like the market like investors ran to safety. They bought some bonds and yields had come down a bit. But yeah, with this news, the 10-year yields came back to 4.2 levels, 2% levels. The US dollar weakened like against most currencies, but strengthened against like the Canadian dollar following Trump's tariff threats. And like euro strengthened as German like Germany news and stuff, because like they also that fiscal expansionary plan had seen some support from Germany's leader. And Bitcoin is like currently like traded around like 81k levels. So let me try to show you a few charts here quickly. Yep. So first of all, yeah, here. First of all, here you can see, I would like to start with the oil chart. In the weekly chart, you can see, first of all, in the beginning of April, it is expected to like the OPEC Plus is going to like increase the like supply, and like the general mind like that will also help to decrease in like a global inflation for sure, and that will lead some like a lower oil prices. And I just wanted to mention this like a descending triangle chart pattern on the weekly scale, and potential breakdown from here would lead lower oil prices, and that might be a good opportunity to short oil. Second chart, Bitcoin chart. If you're following this video, I had mentioned after this like a breakout, it was consolidating, and to see such pullback to see such correction, I think it's pretty normal. In the daily chart, like this trade idea was sent through Rationale newsletter. You can find the link to subscribe below the video. You can get all these kind of like trade ideas directed to your inbox. And after this like a breakdown, pullback, and rectangle chart pattern price target is reached, now my next step will be patiently watching to see if we're gonna see any consolidation around here, or to see an extra. If we see a consolidation and any potential attempt to like go above this like a red line, which is 200-day moving average, I might try to be long on Bitcoin again. Quickly, S&P 500. I think like losing this line plus 200-day moving average is not good for sure. Aside from anything, aside from hopes, aside from emotions, when if I didn't know the ticker of this chart, I would first come with the weekly chart. I will see that it's traded below all like a long-term moving average of 40-week and 10-week, and I would probably skip this chart. With that mentality, I'm trying to be like more logical, and I think like after still the main uptrend is intact, because you know this huge, when you go to the weekly, when for example it started to move from here, as you can see, there is another time that we had seen some trading like below 200-day. It might go up again. It's not what I'm trying to say, but I think it's not the correct time to touch right now, to see some at least reaction. If we're gonna see any reaction, that will be important. Here DAX, after this huge move, this like a US exceptionalism is done, questions were going on, and that, I mean, during the time that this huge price move, there might be an attempt to form a top, like a reversal chart pattern around here. I'm watching DAX closely, and US 2-year yields quickly, let me show you. I'm watching here, and if we see more flight to safety with the risk off narrative, we might see a breakdown from here, and that would be also parallel with the potential Fed's decision to act earlier than expected. And yeah, that's all I'm going to talk about this week. This week was, the data flow was really like busy, and I just wanted to focus more on that side to explain as much as possible what's shaping the current market condition, what are the leading factors that are important on pricing. And yeah, that's all I'm going to talk about this week. If you find whatever you see in this video, please subscribe to the Market Soul YouTube channel. Plus, from the links in the description, you can see that the Market Soul website. Please visit to see that like a multi-asset brokerage firms features, and also there's a Rationale website link, which is like a newsletter service that you can subscribe and get all kind of trade ideas, from like a commodities to FX to equities, directly to your inbox. I wish you a really good week. Bye.